Live in Indiana or use the Indiana 529 plan, you know it's got the very best tax credit out there, but there's 3 limitations. I'll explain that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Okay, recently did a video about some tax benefits with 529 plans in general, right? So on YouTube, obviously we got folks that listen and are fans from all over the country and all over the world. And so each state has their own 529 plan, and each state can, not all do, but each state can offer some state tax incentives. And just so turns out that where our headquarters is, where I live in the state of Indiana, we have the best. We have the best. That's not braggadocious. This is just factual, actually, that we have the best state tax incentive out there. The deductions are good. Credits are great. And Indiana offers a tax credit, a pretty handsome one at that. And so in that discussion, I kind of pointed on that and got a lot of questions, a lot of comments on that video about how does this work? And I live in Michigan, but work in Indiana, or I live in Kentucky, work in Indiana. How's this work? And this and that. And I thought, okay, well, normally I'm creating videos that would apply to more people, but just in case you live in Indiana, know someone that does, pays Indiana tax, whatever, wanted to break down the Indiana 529 tax credit for you and then really talk about 3 key limitations that it entails. Just to level the playing field, 529 plan, that's a federal law, so all states have them. But at the federal level, it works just like a Roth IRA, okay? So your contribution to the 529 plan, there's no tax benefit. It's after-tax money that goes in there. You invest those dollars however you wish, and you're limited in the choices you have in the 529 plan. But all that investment activity, that's sheltered from tax. So dividends, capital gains, all that stuff, while the money's in there, that's all sheltered. And then when you withdraw the money federally, the growth, if it's used for a qualifying educational expense, then that growth comes out tax-free. And because you never got a tax benefit on your contribution, that comes out with no tax consequence as well. And so that's how the 529 plan works in every state. But then each state has the option, or each state does kind of sort of sponsor, have their own 529 plan. And they can, not all do, but they can offer a special state benefit on your contribution or on that plan. And so how Indiana's works, well, I'll tell you really briefly. We live near the border of Michigan. I grew up in Grand Rapids. And Michigan, the tax benefit for living in Michigan and using the Michigan 529 plan, you make a contribution, you get a tax deduction on the first 10 grand that you contribute to a 529 plan each year, but it's a net 10 grand. So if you contribute 10 for, let's say, a younger child, and you withdraw 10 out of an older child's account that's already in college, that's a net contribution of 0. There is no tax deduction there, right? But if you just put 10 grand in and you don't withdraw any, you get a $10,000 deduction on your Michigan tax return. That's Michigan. Many states have deductions like that. Indiana, it's a tax credit, and they just made it even better. That tax credit is, so here's limitation number 1, okay? And we get this question all the time, and it's sort of embedded in how the tax credit works in Indiana. The tax credit is 20% of what you contribute. So that's a lot. Up to, or on the first $7,500 that you contribute for that year. It used to be $5 grand, but $7,500. So 20%, if you put $7,500 in, you get a 20% state tax credit. That's a $1,500 tax credit. So what's so limiting about that? Well, so that's how it works, but here's the limitation, because oftentimes people then say, well, I've got 3 kids, so can I contribute $7,500 to each child? No, it's $7,500 per year, basically per tax return. So that's the maximum. I get this question also with grandparents. Well, I've got a few different grandkids. Can I make a contribution to each of theirs and get a bigger benefit? No, it's on $7,500. That's the cap per tax return. And again, that credit amount is 20% which would equal on 7,500 would equal $1,500. If you only put in $1,000, 20% of that, $200, that's going to be your tax credit. All right, second limitation, and this one's a big one, and this sort of answers most of the questions that I got on that previous video. This is a state tax credit, a state tax credit. Therefore, if you're listening to this and you live in Hawaii, awesome, you have much better weather than we have here, but you don't pay Indiana tax, and therefore it wouldn't benefit you to make a contribution to the Indiana 529 plan because the credit is on Indiana taxes and you don't pay Indiana taxes. The other thing, and this is also more relevant, I guess, for folks that live near the border, maybe live in Kentucky or live in Michigan, but they work in Indiana. Well, in those instances, you're going to pay Indiana county tax, local taxes, but not state taxes, most likely, unless you own a business or property in Indiana. And again, the limitation here is it's a 20% state tax credit, so state taxes, not county taxes. And I'm going to tuck in a big limitation into the second one, and that is, well, what happens if there's more credit than you have state tax? If you've got enough credit that it wipes out all of your state tax, it's not refundable. So again, going back to the absurd example where you live in Hawaii and you heard about this tax credit, and so you want to fund the Indiana 529 plan and receive a state tax credit, but I said, no, you don't pay Indiana tax, so there's no benefit. Well, then I'll just get a refund. Now it's a non-refundable credit, which means the credit will go to offset Indiana state tax that you have. But if you have more credit than you have Indiana state tax, then it will just wipe out the tax you have. It will not create a refund for you. Confusing, I know. This is why you need to be working with the certified financial planner that's doing comprehensive financial planning, and part of that is tax planning. Because again, this fits right there where I have a goal of helping my kids or maybe my grandkids with their education, and also, I also have my other financial goals. So how can this one work? And then from a tax standpoint, what's the best way to do this? So, all right, the third and final limitation here is you only get this state tax credit if you are using the money, if you choose to use the money for qualifying educational expenses. Now, wait a second. You might say, that doesn't make sense. You get I think, you had said that you get a tax credit on your contribution. You have no idea how you're going to use those dollars. How can you know? Well, you do get that tax credit at the time in the tax year that you make that contribution. So you get that tax credit then. But if you end up withdrawing the dollars from your 529 plan for a non-qualified educational expense, you actually need to recapture that tax credit, which even though it's just an offset, say for example, you put $7,500 in now, again, you get that state tax credit, so you get a $1,500 tax credit, and the dollars are in your 529 plan, and you say, pinky swear, I'm going to use this money for a qualified educational expense. So tuition, room and board, books, computers, meals, that sort of thing. But then your child never goes to school. And so you'd say, well, instead of leaving these for the next child or grandkids or whatever, I'm just going to pull the dollars back out. Well, if you just pull the dollars back out, that's a non-qualified educational or non-qualified withdrawal, and therefore you'd have to repay that $1,500 tax credit on your Indiana taxes. And guys, you might listen to that and say, well, okay, that makes sense. You got to benefit up front. You got to give it back if you didn't use the money for the right purpose. It feels like a penalty. It feels awful. So therefore, working with your certified financial planner so you have a strategy and a game plan to make sure you're contributing the right amount for the right purpose into that 529 plan, and that you're aware of all of the reasons and times and opportunities and all that for using the dollars so you don't have to make a non-qualified withdrawal. Speaking of 529 plan, I've done several videos about some of the expanded uses. It used to just be for higher education, not anymore. And in Indiana, even though at a federal level, you're able to withdraw a certain amount once in your lifetime to use from a 529 plan for student loans, that's not a qualified withdrawal for Indiana. So if you contribute money to the 529 plan in Indiana, get that tax credit, and then withdraw that money back out to pay on student loans, you're going to have to repay the tax credit that you got. And then the other one that we're still all just waiting to hear how it's all going to work is being able to transfer some extra 529 plan money into the Roth IRA. I don't know yet, haven't heard, haven't seen it. My guess is Indiana is going to say that will be a non-qualified withdrawal from the 529 plan. We'll see. I hope they don't, because that would be a big disappointment, but we will see. So work with your certified financial planner. If you should be using a 529 plan, make sure you understand the rules, both the benefits on the way in, but also the limitations on the way out. So work with your CFP on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.